Today, I wanted to talk about quantitative easing and how it drove mortgage rates in 2020 through 2022, as well as how that relates to rates now. But first, I definitely need to touch on the jobs report. Just yesterday, I mentioned that the Fed was still monitoring inflation, spending, and jobs closely and looking for more weakness before they would consider more cuts. Boy, did they get some weakness a day later. Earlier today, the jobs report dropped. Only 73,000 added in July against an expectation of 100,000. But much more shocking was the downward revision totaling 258,000 jobs across the previously posted May and June reports, meaning they basically said, my bad, the actual figure should have been a whole hell of a lot lower. Bond yields reacted sharply with the 10-year Treasury dropping more than 10 basis points as investors reassessed future Fed policy. If you're wondering what that means for mortgage rates today, they were a little better, but nothing drastic. This still isn't a long-term trend, but it does reshape the forecast a bit. Here are some things to take note of. The odds of a September Fed rate cut rose from about 40% to 60 to 70%. But core PCE is still trending a little too high at 2.8%, and tariffs remain an inflation wildcard. As Powell noted, higher tariffs may be a one-time shift or become persistent. Now, I want to discuss qualitative easing as that is the biggest hammer in their toolbox for affecting mortgage rate that nobody in lending seems to understand. But first, what is qualitative easing? At its core, qualitative easing is when the Federal Reserve creates money to buy long-term securities like U.S. Treasuries and mortgage-backed securities. This artificially increases demand, which pushes yields and therefore mortgage rates down. The goal is to stimulate borrowing, investing, and economic growth, especially when the Fed fund rate is already near zero. It's like turning on a monetary fire hose and flooding the bond market with buying power. That flood is exactly what drove mortgage rates to the twos during the pandemic. Now, during COVID, rates plunged not because the Fed cut the funds rate, but because it was buying up everything. No investors would buy a mortgage-backed security at 2% except for the Fed. The Fed bought trillions in mortgage-backed securities. This artificially lowered yields on MBS and moved mortgage rates towards the mid 2% range. But in 2025, the Fed is doing the opposite. It's continuing quantitative tightening, where they are shrinking the balance sheet by not reinvesting in mortgage-backed securities and no more buying. Quantitative tightening is scheduled to continue through year-end with flat normalization through mid-2026, according to a report from Wells Fargo. The Feds are never going to give us a specific date on this. In plain English, quantitative easing is off the table for now. Why that matters for buyers and realtors, rate cuts alone won't send mortgage rates back to 2 or 3%. Qualitative easing is the only tool powerful enough to do that, and it's not happening. Mortgage-backed securities are instead placed on the open market, and investors on the open market aren't interested in those low rates at all. They need a bigger rate of return to make them viable. Now, if inflation can get down to the Fed's target rate of about 2%, and we have some pain in the economy, I would say you may see rates most likely in the low fives or upper fours, best case scenario, but we're still likely a ways away from that. So hope that helped explain what quantitative easing is. Tomorrow I was going to talk a little bit more in detail about quantitative tightening, and then we'll get back to regular, programs, products, stuff like that. If you have a question, drop a comment, reach out. You know where to find me. Take care.